Imagine waking up one day and realizing that the place you trusted most with your money has been quietly making you poorer for years. Not by stealing your money, not by charging obvious fees, but through a habit so normal, most people never question it. In fact, millions of hardworking people follow this habit every single day. They get paid, they deposit their paycheck, they keep their savings in the bank, and they believe they are doing the responsible thing. But what they don't realize is that this one banking habit is slowly destroying their financial future. And the worst part, banks hope you never learn this, because the longer you follow this habit, the more money they make from you. Today, we're going to expose what that habit is, why it quietly drains your wealth, and what smart people started doing differently in 2026. Chapter 1: The Safe Money Illusion. For most of our lives, we were taught one simple rule about money. Put your money in the bank. Banks are safe. Banks are responsible. Banks protect your savings. And to be fair, banks do protect your money from theft. But what they don't protect you from is inflation. Inflation is the silent force that makes everything more expensive over time. Groceries, rent, healthcare, education. Every year prices rise. But the money sitting quietly in your bank account, it barely grows. In many cases, it doesn't grow at all. Your bank might give you 0.5% interest. Meanwhile, inflation quietly increases prices by 3, 5, sometimes even 8%, which means something dangerous is happening. Your money is not growing, it is shrinking, not physically, but in purchasing power. That means the same amount of money buys less and less every year, and most people never notice because the change happens slowly. Chapter 2: The Real Cost of Doing Nothing. Let's imagine something simple. Someone saves $10,000 and keeps it in a bank account. They feel responsible, they feel disciplined, they feel secure. But if inflation averages around 3% per year, something surprising happens. The real value of that money slowly declines. This relationship between growth and inflation can be visualized through the compound interest formula. A equals P times 1 plus R to the power of TA, where P is the initial amount, ER is the rate, T is time. Now imagine inflation quietly working against that money for 20 years. That $10,000 might still show $10,000 in the bank, but its real purchasing power might only feel like $5,500. Half the value, and no one took anything from you. You simply followed the habit everyone told you was safe, keeping too much money sitting idle in a bank account. Chapter 3: Why Banks Love This Habit. Now here's where things get interesting. While your money sits quietly in your account earning almost nothing, banks are doing something very different with it. They lend it. Banks take deposits and use them to create loans, mortgages, business loans, credit cards, and those loans earn interest, often 5, 10, sometimes even 20%. So the bank might pay you less than 1%, while earning many times more using your money. Your money is working, just not for you. This is not illegal. This is how banking works. But it reveals something important. The system rewards people who use money strategically, not people who simply store it. And the longer money sits idle, the more opportunity disappears. Chapter 4: Why People Keep Doing It. So if this habit quietly destroys wealth, why do so many people continue doing it? Because it feels safe. Humans are wired to avoid risk. The idea of investing can feel confusing. Markets fluctuate. News headlines talk about crashes. And many people were taught something very simple growing up. Saving money is good, investing is risky. But what most people never realize is this: not investing can be risky too. Because inflation is always moving, prices are always rising, and time never stops. Doing nothing with money might feel safe today, but over decades it can quietly erode wealth. Chapter 5: What Smart People Do Differently. People who understand money think about it differently. Instead of asking one question, how can I keep my money safe? They ask a better question: how can my money grow? This doesn't mean gambling. It doesn't mean chasing risky trends. It means understanding one powerful concept: ownership. Owning assets that grow over time: businesses, investments, index funds, real estate. Assets have something savings accounts do not. They participate in economic growth. When companies grow, assets grow. When productivity increases, assets increase. When economies expand, assets expand. And over long periods of time, assets historically grow faster than inflation, which means instead of fighting against inflation, your money moves with it. Chapter 6. The balance most people miss. Now, this doesn't mean banks are useless. Banks are still essential for daily financial life. You need a bank account for paychecks, bills, emergency funds, liquidity. But the mistake many people make is leaving all their money sitting there. Smart money management usually follows a balance. Some money stays liquid, some money stays safe, but some money must grow. Because wealth rarely comes from storing money, it comes from deploying money. The habit that quietly destroys wealth isn't spending too much. It isn't buying coffee. It isn't small daily purchases. It's letting money sit idle for years without a purpose. Banks protect money from thieves, but only you can protect it from time. Because the biggest cost in finance is not risk, it's missed opportunity. And once you understand that, you start looking at money very differently. If this video helped you see money more clearly, subscribe, because the rules of money are rarely taught in school. But once you learn them, they change everything.